Have you ever wondered how economists do it? I mean, how do they take this massive, complicated thing, an entire country's economy, with millions of people, businesses, and all these transactions, and somehow boil it all down to a single number, like gross domestic product? It seems kind of impossible, right?
Okay, so let's really get into this. How do you actually put a price tag on everything a whole nation produces, earns, and spends in a year? Well, it turns out there isn't just one way. Economists actually look at this problem from three totally different angles, kind of like looking at three sides of the same coin.
To make this super simple, just picture a local bakery. We could figure out its economic value by adding up the price of all the bread it bakes, right? Or we could add up all the income it pays out, the wages to the bakers, the rent for the shop, the profit for the owner. Or we could just track how much money all the customers spend there. And here's the thing, in theory, all three of those numbers should be exactly the same.
So that's what we're going to break down here. We'll start with the puzzle itself. Then we'll dig into each of those three angles: what a country makes, what its people earn, and what everyone spends. And then at the end, we'll see how these three different views kind of magically end up at the very same number.
All right, let's do it. We're scaling up from our friendly little bakery to the huge complexity of an entire nation. How do we solve that puzzle? Let's get into the first angle.
Let's start with what feels like the most obvious angle: production. The basic idea here is super simple. If you want to measure an economy, you just add up the value of everything it produces. This is what's officially known as the value-added method.
Okay, I know, the official definition sounds a little dry, the sum total of net final output. But the key words to grab onto here are net and final. And those words are crucial because they tell us we can't just go and blindly count every single thing that rolls off an assembly line. Nope, we've got to be way smarter than that to avoid a massive miscalculation.
So here's how they do it, in 4 steps. First, economists sort every single business into a sector: primary, which is stuff like farming; secondary, which is manufacturing; or tertiary, which is services. Then, for each business, they calculate what's called the net value added. After they add all that up, they make one final adjustment for something called net factor income from abroad, which is basically just adding income our citizens earn overseas and then subtracting what foreign citizens earn here.
But this whole method has this one huge potential pitfall, what's known as the double counting trap. See, if you're not careful, you could end up counting the exact same value multiple times as it moves through the supply chain. And that would make your final number way, way bigger than it should be.
And this is the clever solution. Economists draw a really sharp line between intermediate goods and final goods. So the flour a baker buys, that's an intermediate good. Its cost is already included or baked into the price of the final loaf of bread. By only counting the final product that gets sold to a customer, they completely sidestep the problem of counting the same value twice. Pretty smart.
All right, let's flip the coin. Time for angle number 2. Instead of looking at what we make, we can measure the economy by looking at what we all earn. This is called, you guessed it, the income method. Now, the logic here is really solid. Every single dollar spent on a final good or service has to end up as income for somebody. It has to. That dollar might become wages for an employee, or rent for a landlord, or interest for a lender, or profit for the business owner. It all has to go somewhere. So what economists do is they add up all these different streams of income. Usually, the biggest slice of the pie is compensation of employees. That's all the wages and salaries. Then you've got operating surplus, which is the income from capital, so things like rent, interest, and profits. And finally, there's mixed income, which is basically the earnings for self-employed people, where it's hard to separate out their labor income from their capital income.
Now, this is where it gets really interesting, because not all money that changes hands actually counts as national income. A pension, for instance, is a transfer payment. It's not a payment for something produced right now, so it gets excluded. Same goes for winning the lottery. But get this, the imputed rent of homeowners is included. Economists basically pretend that homeowners are renting their own house to themselves, just so they can capture the value of the housing service they're getting.
And that brings us to the third and final side of our coin, the expenditure method. It makes sense, right? If all that production creates income, then that income gets used for spending. So another way to measure the economy is just to track where all the money goes.
This approach breaks all spending down into 4 main buckets. You've got C for consumption, that's all of us, households spending our money. You've got I for investment, that's businesses spending on new equipment, plus all new home construction.
Then there's G for government spending on public goods and services. And finally, you have net exports, which is just the value of our exports minus the value of our import.
And just like with income, there are some tricky rules here. For example, buying a brand new house is considered an investment, not consumption. And if you buy a used car, the value of the car itself doesn't get counted. It was already counted the year it was made. But the car dealer's commission does get counted because that's a service provided this year. See, it's all about tracking the value that's been created right now.
So, we've looked at the economy from 3 totally different perspectives: production, income, and spending. Let's bring it all together.
First, we measured production, adding up the value of everything we make.
Which in turn generates income, in the form of wages and profits.
Which is then used for expenditure to buy all that stuff.
And here's the big reveal, the whole point. In a perfectly measured economy, these 3 numbers must be equal. The value of what's produced has to equal the income earned from producing it, which has to equal the amount spent to buy it. They are literally 3 sides of the very same coin.
And that single number gives us this incredibly powerful snapshot of an economy's size. But it also leads to a much, much deeper question. This number, it measures economic activity, sure, but it doesn't measure happiness or inequality or the health of our planet. So what does this one big number really miss when we're trying to measure a nation's actual well-being?